welcome you all to this, our webinar for January 2022. We have this edition courtesy of the support of AELEX.
The purpose of this seminar is also to enrich your knowledge on the Finance Act 2021, how the Finance Act 2021 affects your disposable income and allow you plan and make corporate and financial business and investment decisions. We encourage our participants to post their question on the chat box. Ladies and gentlemen, who better to give an insight on the implications of Finance Act 2020 on the business than our guest, partner, head of deal. Mr. Ajibola, you have the floor.
Thank you very much, Mr. Jose. Thank you very much for your very warm welcome. I blushed a little bit at some of the very high praise in your citation. 30 years, who would have thought it? Theo, we're getting old, you know. So
but we're old already.
You know, I mean, I don't know where the years went, but hopefully we can share some of our experience, Theo and mine, with the audience this morning. It's a really, really important association, the Nigerian-American Chamber of Commerce. And for those of us at KPMG, we're very proud of our association with this highly esteemed chamber. And we do not take your platform very lightly at all. We're grateful to have been invited to share your platform this morning and share our thoughts on a very important subject, which is the legislation that was signed by the President on the 31st of December 2021, being the Finance Act of 2021. Of course, the law is expected to take effect 1st of January 2022. And people have often wondered why the law is not titled Finance Act 2022, since it's supposed to take effect in 2022. But it's a naming convention thing. And because the law actually was passed by the National Assembly in December 2021 and signed by the President in December 2021, it has to have a 2021 year as part of its name. So please understand that Finance Act 2021 actually relates to fiscal year 2022, and it is intended to help finance the budget, the national budget for 2022, which has also been signed into law by His Excellency the President. I only have a few minutes before I yield the floor, but given the composition of your highly esteemed chamber, I thought rather than go through a detailed review of the legislation, which we may not have time for, we should emphasize some aspects that are likely to be of particular interest to the people here gathered. And if you then have questions thereafter, I'll be very happy to take a range of questions. I know Theo is also going to share a few words on the legislation. So this is the third in a series of finance acts that has been introduced by this government, and it is a return to the era of disciplined fiscal planning that the country has not really witnessed since the advent of civilian rule in 1999. In the days of the military, finance acts used to be promulgated pretty much on a yearly basis. But since the civilians took over, the discipline and the practice of using this kind of legislation to stimulate the fiscal environment has actually taken a backseat. So it is noteworthy and commendable that the government of Nigeria has returned to an era of fiscal discipline, signaling to the public the measures and means by which it intends to raise public finance for servicing the public good. And the legislation does not make sea changes. In a sense, it makes incremental changes. And I'll now begin to describe some of the changes that this year's version has brought about. In terms of the thematic areas covered by the legislation, there were 5 key ones. First one being, of course, domestic revenue mobilization. Second one being tax administration and legislative drafting. As we all know, the Federal Inland Revenue Service, very competent organization, very professional organization, has taken a major step forward, starting from last year, in adopting digital strategies for implementing its statutory mandate to administer the tax legislation and collect tax revenue for the government. They have introduced software and technology, for example, the ProMax technology, which all taxpayers are now using to file their tax returns and render payments to the government of Nigeria. And the early, of course, it's early days, yes, but the early feedback from that system is evidenced in the statistics. And so in 2021, as of October 2021, the FRS had raised almost 6 trillion in revenue, which was significantly above its budget for the year. In other words, by adopting technology, the FRS has been able to close tax loopholes and also bring more into the tax net. And they must really be commended. And we hope that this drive continues. In fact, you will then see that in the budget of 2022, an incremental budget has been given onto the FRS to build on the successes they have made, starting from 2021 with ProMax and other technologies, to take technology to the next level in administering tax laws in Nigeria. The third thematic area is international taxation, which is interesting because, of course, Nigeria did not sign to the Pillar 2 conventions around digital services tax and the other matters. But still, there's a view that Nigeria needs to move closer to international standards of taxation. Fourth area is in terms of fiscal sector reform and tax equity. And for people here who are academics, when you view the capital gains tax legislation, it's typically not a significant revenue earner for governments across the world, but it is typically focused on as a means of ensuring fiscal equity. So you find that for individuals in paid employment who constitute the bulk of revenue receipts from personal income tax, you will not find many high net worth individuals paying personal income tax because their income tends not to be from employment or from their income tends to be in the capital gains area. So you find that in countries across the world, there's this debate over whether capital gains should be taxed. If you remember in the Trump era, Trump in the US did not believe that the rich should pay more tax because he felt that if you can create wealth, you should be given a break because it is the rich that actually create businesses, that establish new businesses, that then employ people who can then pay tax. So there's a huge philosophy around what do you do with capital gains. And Nigeria has now signaled this year that tax equity is going to be critical in the minds of fiscal planners. And we introduced capital gains tax on elements of income streams that strategically flow more to the upper class, to the richer segments of the society than the lower class. In fact, in introducing those capital gains tax, exemptions were given to low-income earners. So, for example, your capital gains tax threshold would only be triggered if you engage in sales which are above 100 million. So clearly, that's telling you that this is intended to be a tax on the rich and not on the generality of the Nigerian masses. The fifth thematic area is public financial management reforms. And there are many companies that complained about multiplicity of tax audits and tax administrators that come knocking on their doors, RAMFAC audits here, National Assembly audits there, all auditing the same tax numbers. The Finance Act in the public financial management reform sector has made clear that FRS are the primary agency of government responsible for undertaking tax reviews and collecting tax revenue. So any other agency that does so will do so at the risk of the officials being sanctioned, criminally sanctioned for breaching this law. On the right-hand column, I give you a list of the statutes that have been interdicted by the Finance Act of 2021. On my next slide, I now begin to go into the meat of the areas that may be of even more interest to people here. The very first one, because there's a plethora of manufacturing companies who are members of this highly esteemed chamber. There has been an introduction of excise duty on non-alcoholic, carbonated, and sweetened beverages. And so in Section 17 of the Act, of the Finance Act, Section 21 of CETA, not income now, excise, the Customs Excise Tariffs Act, has been amended to introduce an excise duty of 10 naira per liter on non-alcoholic, carbonated, and sweetened beverages. Now, we've received a host of inquiries as to what this might mean. Is it a tax on input? Is it a tax on output? Should it be charged separately to the consumer? Should it be bundled into the sales price and so on and so forth? Why are we even doing this? The carbonated drinks are really the last mile for poor Nigerians. Are we asking poor Nigerians to pay more? And I believe, just by listening to the conversations around the table, and also from the direction of international commentaries by health practitioners for the most part, the governments across the world are beginning to look at a concept called, colloquially, sin taxation, where governments begin to think of those behaviors in the fiscal space that trigger more public expenditure. So, for example, some would argue that if you consume too much sugar, you may be at risk of obesity and then maybe the higher incidence of diabetes, which then puts a burden on public finance to provide health and other interventions to people who then suffer from those diseases. So there's been a huge lobby across the world from the health sector requiring governments to impose taxes on things like sugar. And we've seen even countries like the US that have introduced increased taxes on sugar products. Nigeria appears to have joined the list of countries because in the Finance Act of 2021, this levy was introduced, 10 naira per liter. And the real question is, can we take it? So I would like to urge the manufacturing sector to see this as an initial signal. To my mind, it's probably not the end of the conversation. There is scope to engage with the government to discuss the implications and the impact of this levy. For example, what is the impact on consumer, on the consumer, on the wallet of the consumer? Because the Nigerian consumer's wallet is not completely elastic. In a sense, how much more tax can the consumer pay? The manufacturer is not going to take this 10 naira, likely going to pass it on to the consumer. So if the price of a bottle of Coke or a bottle of Pepsi, a bottle of any other product should increase on account of this tax, what does it mean to the consumer? Does this mean that they have to make a choice when they're drinking their Coke, not to also buy sandwiches, not to buy bread? Do they have to make a choice between consuming these products and sending their children to school? What is the implication for them in terms of the impact on their wallet, in terms of how much they spend on their own health? And what other measures can the government take? Either to supplement this tariff, review this tariff upwards, downwards, sideways, anyhow. The room is wide open for the sector to engage. Put more information at the disposal of the government. What are the drivers that we're seeing in Nigeria specifically, and not so much about what the world is saying about these products? The other thing to pay attention to is that excise duty is typically on production, manufacture, or production of goods. It's not typically in Nigeria on the input. It is possible that your product, your output can be an input to somebody else. And in some countries where you use goods that have suffered excise duty as an input into your manufacturing process, you can sometimes obtain input excise duty relief. Nigeria does not specifically provide for that. So there is again scope for engagement with the fiscal authorities, including the FPRC, which I have the distinct pleasure of being a member of, to put material in front of the draftsmen and the policy planners as to why we need to actually look at the whole concept of excise duty in a holistic manner. Should we introduce input excise duty recovery? Should we find a way of mitigating the overall impact of this? But ultimately, the burden will be on the consumer, so it will be on the manufacturing output. In other words, it will be on the final product that's coming out of your factory, and not on the consumption of the actual. So it's not on the liter of sugar you purchase, it is on the products that come out of your manufacturing process. The other question that typically arises is whether this levy is to be paid to the FRS, but the answer is no. It's an amendment to the customs and excise tariffs Consolidation Act, and that vests the power on the Customs Service to administer the law. So the agency that's saddled under the law with the administration of this levy is the Customs Service. So for companies in the manufacturing sector, you typically have customs agents that sometimes take positions in your factories from which they can actually superintend the calculation, the due calculation of excise duty and other matters that the Customs and Excise Management Act is concerned about. The next provision that I think is of importance to members of your chamber would be the one that relates to the digital economy, if you like. We all know that global digital trade is growing in leaps and bounds. In fact, the entire world is no longer a village. It's actually just a family. Back in the day, we used to say, oh, the world is becoming a village using globalization and all. But today, it's actually in your hamlet. It's actually in your family homestead. So the whole world is becoming a family unit. And so you have companies operating situated outside of Nigeria who are simply able to stage their own fiscal environment without reference to geography. And countries around the world have struggled to understand how to harness the contributions from those global players to the local economy. And of course, that's the whole idea around international taxation, the global arrangement that President Joe Biden of the US announced last quarter of 2021 around harmonization of tax rates agreements as to global tax policies. As you all know, Nigeria did not sign up to the Pillar 2 Accords because one, the threshold was too high. I mean, the FRS had been on a roadshow explaining why Nigeria did not feel comfortable signing up to those accords. The thresholds, the kind of material that's in the agreement do not appear to be favorable to the developing world. It seemed to favor more the highly developed nations of the world. So I believe that the round of negotiations is currently ongoing, and eventually Nigeria will come in from the cold. I think there are only 3 countries across the world that failed to sign. But then in the Finance Act of 2021, some focus was still given to companies that undertake digital trade. As you all recall, in 2019, the tax code, the Companies Income Tax Act, was amended to provide specific categories for companies undertaking digital provision of goods and services. And when those companies trigger what is known as a significant economic presence in Nigeria, they then fall into the Nigerian tax net. Excuse me. Apologies. So when you fall into the Nigerian tax net, you are expected to file your returns on an annual basis. A number of these companies have actually complied with the requirements of the law, but there is a gap in the sense that it is not clear what should happen if those companies fail to file their tax returns. Tax professionals like Theo and I have argued that the FRS always have power under the Companies Income Tax Act to issue a best of judgment assessment and subject those companies to tax on the basis of a fair and reasonable percentage of their turnover. So we didn't really see a gap. However, the tax administrators felt that there may be a gap in reality, and they have provided in this section a basis for a clear legislative basis for the FRS to assess such non-resident firms on a fair and reasonable percentage of their turnover from providing digital services to Nigerian customers. And these digital services would include things like apps. So you can go to the Play Store or the iTunes Store and download apps, high frequency trading, electronic data storage. And we all know that data repositories are springing up all over the place now, and cloud computing, which a lot of Nigerian companies are undertaking, is beginning to allow Nigerian companies to store their data in the cloud, and the cloud is not necessarily based in Nigeria. So you're looking at high density computers situated in other countries to aggregate data from operators across the world. Now that's on the income tax side. So those activities will be liable to companies' income tax, and the FRS has been given more basis, more power to target companies that do so. Before you leave that slide, I think we should also talk about the VAT implications, because VAT provisions have also been made. I think that's actually on this slide. VAT provisions have also been made in order to close the loop in terms of what happens when you go onto a global platform, a global trading platform that's not headquartered in Nigeria, and you make a purchase, Alibaba, etc., and so on and so forth. You log onto their platform from Nigeria, you make a transaction. You're on Twitter, and you make a purchase. You're on Instagram, you make a purchase. But those platforms are not necessarily registered for tax in Nigeria. What happens to the VAT? There should be VAT on goods and services purchased. How do you aggregate that in a sense where the trader or the platform you're utilizing is based in China? How also do you enforce compliance when the individual that's making that purchase is making a very small purchase and therefore is not in a position to withhold that VAT at source? The Finance Act has closed that gap now by amending Section 10 and 14 of the VAT Act to empower FRS to appoint any person, which would include a non-resident person, as an agent to collect and remit that VAT to the FRS on a periodic basis. So if you again think about it, you go on to Amazon, for example, and make a purchase, then FRS can appoint Amazon as their agent to collect the VAT on that transaction and remit to them. And happily, you can see that there's been an upsurge of compliance, and global trading platforms like Amazon have actually made announcements that from 1st of January 2022, they will be adding VAT to their payment protocols, so that when you are making a purchase on their platform, if you are making that purchase from Nigeria, you will then have to pay a VAT. Now, of course, these are early days. There are still gaps to be exploited. For example, how do you determine that the trade is situated from Nigeria? Is it based on the IP location? What if I'm using a VPN that shows my location to be somewhere outside of Nigeria? Or what if I'm actually outside of Nigeria and I make a purchase to be delivered to Nigeria? Does that also fall into the tax net? So all those algorithms, all those details will still be worked out. But it is sufficient for the time being to say that there's a signal through the Finance Act that when you undertake global trade using electronic platforms that are not typically based in Nigeria, you need to account for the Nigerian VAT on the Nigerian aspects of such transactions. Now, so that's typically what we call B2C transactions, business to customer transactions. In the B2B space, the intention and expectation of the Act is that the B2B customer who is based in Nigeria will continue to have the obligation to deduct and remit in the manner that we are all already familiar with, the VAT on such transactions to the FRS in due course. I know I was given only 30 minutes for my slides, but I still have quite a lot of material to go through. So what I would suggest is, rather than go through the material, I'll simply highlight. So there were provisions made, for example, to operationalize the NACC levy. Now, this is very important because the NACC Act previously applied to all companies that had turnover above 4 million naira, and it required them to pay a certain percentage of their profit before tax to the agency. It was a difficult legislation, actually observed in the breach. Nobody was complying with it, and so this year, the government has looked at that legislation and made changes to it in order to make it a bit more targeted and a bit more enforceable. And so FRS has been directed to implement that levy, and it will be funded. NACC will be funded by 1% of FAC, and also 0.25% on profit before tax of major commercial companies. And commercial companies have been described as companies in banking, telecoms, ICT, aviation, maritime, oil and gas. Once you have turnover above 100 million. There are questions as to whether this law will be applied retrospectively or prospectively. Our own view is that the questions do not arise because the law has always been in place. What has not been in place has been an intention by the administrators to enforce it. But from 1st of January 2022, there is clearly an intention on the part of the fiscal planners that this legislation should be applied. So what we can say with a degree of certainty is that this levy becomes operational from 1st January 2022. As to the historical period, we will continue to argue that the levy was not effective prior to 1st January 2022. But you would need to speak to your tax advisors and your lawyers in terms of understanding what your rights and obligations might be in relation to the historical period. I also made, I had a slide that dealt with shares, the capital gains tax that has been introduced on shares, but I had also covered that in my initial comments to let you know that this is actually intended to be a fiscal policy tool to bring equity into the tax space and make sure that the rich also contribute to the fiscal economy. And the way it's been defined here is that if your transaction is below 100 million naira in terms of a disposal of shares, you do not have to worry about CGT. This will take away the burden of the tax from more than 90% of the holders of shares on the stock exchange and also private companies in Nigeria. If your transaction is above 100 million naira in any 12 consecutive months, in other words, not just a calendar year or a fiscal year, you got to look at any period of 12 months within the calendar year. If you trigger that and you do not immediately reinvest those proceeds into the same stock or similar stock, then you may be liable to CGT. Exceptions are made for companies who are operating in a regulated securities lending transaction. In other words, if you are undertaking SEC lending, typically a financial institution practice and high net worth, also highly geared corporates. If your transaction is regulated by SEC as a securities lending transaction, you're exempted. Also, we know that pension funds assets are exempted because their law already exempts them from paying tax on transactions. The other thing to pay attention to is that this CGT rollback does not apply to bonds and other long-term securities that are issued by the Nigerian government. Note, federal government, not state government. So if you're a state government and you have issued a bond, the interest income on that bond will be liable to tax under the CGT, under the CGT if it is disposed, and the gain on disposal of the stock or of the bond will be liable to tax if disposed. The interest income on the bond itself, depending on whether it's short term, if it's a treasury bill, or long term, if it's more than 12 months, may be subject to tax also under the CGT framework. If it is short term, that will be taxable under CIT. Short term being anything within 12 months. So I won't really go into details of that because I know I'm fast running out of time. But the other matter I should stress relates to unit trusts. And for unit trusts, suffice to say that the law has now technically rendered unit trusts as a complete pass-through as far as tax is concerned. And this is a significant improvement on the tax position that unit trusts previously had, where there was multiplicity of tax on the cash flow that passes through a unit trust. So a unit trust typically aggregates capital for investment purposes from a motley crew of investors, both highly sophisticated institutions and also mom and pop investors. And so if you invest through a unit trust, it tends to be really complicated and the cash flows become less tax optimized. But with the Finance Act of 2022, the final changes required to make unit trusts fiscally transparent have now been made. And I show you a waterfall model, a table here that illustrates at very high level the difference. So without going into details of the slide, just if you look at that table, if your gross proceeds was 200 previously, or before this law, your net distribution to investors would be a maximum of 160. Today, because it is fiscally transparent, the tax will only occur once, and your net proceeds to be distributed is at least 180. Previously also, if your unit trust were to invest in tax-exempt instruments, if you recall, the Jonathan era bond exemption orders which expired also on the 2nd of January 2022. But when that order was in place, if you had invested in bonds, you were tax-free. But if a unit trust were to invest in bonds, even though the unit trust will be tax-free, they will have to deduct tax when paying to you. So you will not be able to get the benefit of that tax-free exemption. But today, with the changes made in the legislation, the unit trust will be able to pass that benefit to you tax-free, which is why I said that 180 you see there is the minimum return you will get on the net distribution to you. While in the table before that, the 160 you see there is the maximum that the unit trust can give to you. So it's really, really fiscally impactful what's been done for unit trusts. There were changes made to SEC lending. On the next slide, I discussed that, but I won't spend too much time on that. And on the next slide, I talk about some of the changes made to empower the FRS and also in relation to the Nigeria Police Trust Fund levy. On the next slide, I let you know that the legislation also increases some penalties that are payable by banks and other financial institutions. Notional increase in the rate of education tax that's payable, and a few other changes, particularly in relation to oil and gas companies. Let me spend a minute, if the organizers will please permit me, one more minute to speak to the one relating to oil and gas companies. Because previous to 2021, oil and gas companies did not have to worry about companies' income tax if you were operating in the upstream area, upstream oil, upstream gas. Because once you pay your PPT, the law declares that you don't have to pay any other tax in Nigeria. But in Finance Act 2020, the law changed to say, even though you have paid your PPT, when you are paying dividends to shareholders, you should still account for withholding tax on those dividends. Secondly, when the petroleum industry bill was signed into law by the president in August of 2021, it was required that oil and gas companies will now pay not only hydrocarbon tax, they would also pay corporate income tax. Now, but if you looked at the corporate income tax legislation, there were exemptions in there for upstream oil and gas companies because that law was drafted at a time when such companies did not have to pay tax. Also, there was a section in the law that said that if you were a company whose products are being exported from Nigeria, you are exempted from tax on the revenue that you earn. And of course, like we all know, for most IOC companies, their output is typically export. It's for the export market. So the implication will be that even though PIB requires oil and gas companies to pay tax, pay companies' income tax, in addition to hydrocarbon tax, they would technically be exempted from paying the tax if the law was not amended. So what has now happened is that Finance Act of 2020 and Finance Act of 2021 have made changes to the company's income tax framework. Firstly, to require oil and gas companies who fall into its category to pay CIT, and secondly, to remove them from the list of companies that can enjoy export incentives under the CIT legislation. We can talk about that some more in the Q&A if you have other questions. And on my final slide, I provide a list of other changes made, for example, in relation to real estate investment trusts on a sectoral basis, consumer market, financial services, oil and gas, and digital economy. So this is a quick summary that the readers can take away as a quick reference point to the bucket of changes introduced by the legislation. So it's a whole host of things, and we can talk about this all day. As you can see, I'm not actually out of steam yet. We could go at this for the next 24 hours. It will give me time. But there will be elements of this that are of interest to different interest groups. Hopefully, Theo will cover a bit more ground, and then in the Q&A, we'll take questions and probably cover all your questions. Thank you very much again for the opportunity to speak to your chamber and to the members of your highly esteemed chambers. We at KPMG are very proud of this, and we are happy that you allowed us to share your platform. We don't take it lightly at all. And also, I can also speak as a member of the Fiscal Policy Reform Committee that was responsible for working with the Honorable Minister for finance, budget, and national planning in putting legislation together, that a lot of input was received from the public, shaping the thoughts that went into drafting this legislation. So of course, I would like to align with all the changes in the legislation that are positive and that the industry reacts to positively. And I would like to, of course, declare mea culpa on those that are probably not so well received. But I can tell you that the work went on for over a year. Besides the fact that we've been doing this for the last 3 years, the work to draft this year's legislation, the 2021 legislation, took over a year to do. And we received input from a whole host of sources, and every single input was hotly debated. Of course, you can expect KPMG will always be on the side of the private sector to look for stability, look for things that are positive to the private sector, without also foregoing the interest of the public sector to raise revenues. But I can tell you that every single input was debated. I say this to encourage your members and your chamber to also get involved in the conversation, because as you can imagine, there will still be a finance bill and a finance act of 2022. And the work on that is starting as I speak, started in January. So what are the things you would like to see? Where are your pain points? What data supports your suggestions for changes to be made in a manner that optimizes your operations, that allows you to continue to invest capital in the Nigerian economy, to create jobs, and to grow the economy of Nigeria? If you have those ideas and you have data that supports your conclusions, please share them with the chamber. The chamber can share them with me or with other members of the committee, and we will pass your views on to the fiscal planners of the economy, and I believe that they will be taken on board. Remember, it's not about you passing your views to FRS. FRS, of course, only want to collect tax. This is about passing your views to the minister, who has a wider mandate to grow the economy. So we can all work together to make this fiscal economy much more positive than it is today. And on that note, I would like to hand it back to the moderator, and thank you very much for your time and patience.
Thank you very much, Mr. Ajibola. During my introduction, when I introduced Mr. Ajibola with over 30 years experience in law, accountancy, and taxation, as you can see, based on the 35 minutes that he has given us an insight into the 2021 Finance Act, I'm sure a lot of you will have been amazed that he just spoke as if he knew exactly what we wanted and spoke to the audience in the language they actually understand. Without taking too much of your time, Mr. Ajibola, thank you very much. May I also introduce one of our panelists, a founding partner, AELEX. AELEX is actually our financial sponsor to this program, to this webinar. With over 3 decades experience as a legal practitioner, a fellow of the Chartered Institute of Taxation and former chair of the Tax Law Reform Committee of the Institute, pioneer chair of the Tax Committee of the Nigerian Bar Association section of Business Law. My pleasure to introduce Mr. Theophilus Amoa, partner head of taxation and corporate commercial and practice good of AELEX. Between the two of them, they have over 60 years. 60 years. Can you imagine? We're getting all this knowledge for free. We have over 202 participants. So I'll just call on Mr. Amoa to just give us his view before we go on to the question and answer session. As I said earlier, please, I will encourage the participants to please post their questions on the Q&A. We want it to be as robust as possible. I think we only have about 15 minutes left, so it's important that, we take as much from you as possible. Thank you very much.
Thank you, Mr. Jose. It looks like you want to retire us.
No.
I mean, if we were in the civil service by now, they'll be asking us to prepare retirement.
No, we're now in the knowledge-based economy. People don't retire until they're 70.
Civil service still has a 35-year rule.
Well, you chose law and law and taxation.
True. Anyway, thank you very much for having me. I'm glad to be here. We've been associated with the Nigerian-American Chamber of Commerce for quite a while. And I'll go straight into my comments. I mean, Ajibola has given us a broad overview of the changes. And he has, indicated that, the sectors, the different taxpayer sectors can prepare for conversations with the tax authority on areas that impact them and how they feel things might, could be done differently. Let's put it that way. Of course, the overarching problem is that there's currently a tension between revenue generation by government and stimulation of the economy. And government truly is struggling with that. I mean, commentators have said that this year, 90% or more of revenue is going to go into debt servicing. So it means that there will be little money left to build roads or anything like that. And the question is, how, will the country, survive? If they don't increase revenue, we may get to the point where, if the revenue may not even be enough to meet debt servicing and administrative costs, and that is a difficulty that the government is facing. So a lot of these things are designed to increase revenue. Of course, the other side of the coin is, if you were to broaden the tax net, get more people in employment, get more people manufacturing, then you'll be collecting from a bigger base, a larger base. Now, how do you do that? And that, that's more than just a tax law issue. It's a bigger philosophical issue as how do you grow the economy? So we'll go into that, but I think that tells us what the government is trying to balance. Now, one of the things that Ajibola mentioned was the change in capital gains tax on shares, and it's been an anomaly for a long time. I mean, many of our clients come to us and say they're doing a transaction, and they ask us about CGT. I say, there's no CGT on shares, and they're a bit surprised. Now it's coming in. Many commentators have suggested that it's focused on portfolio investors in the stock market. That is true, but I can tell you that there are investors, especially PE funds, who do transactions that will be greatly impacted by this new development. At the moment, those investors have to face the FCCPC, which is a merger control regulator, and the fee they pay to the FCCPC is approximately 0.6%. Now, what is going to happen is there's going to be a 10% additional charge. Now, you might say it's 10% of the gain, but quite often what you're having is somebody's coming to buy a company that's been in existence for 10 years, 20 years. So the gain on the initial share price of 10, 20 years ago is 90% of that consideration. So you can see what CGT will do to transactions like that. People are going to have to think carefully as to how they go about this. I mean, the seller will be reluctant to take, the hit. The buyer will be reluctant to take the hit. So somehow it's going to make it, they're going to have a conversation on how they go about it. Of course, it's a new avenue for government to raise money. It's nothing unusual. In most other countries, there's a tax on capital gains on shares. So this is not, something unusual. So eventually we'll learn to live with it, but it is something that will have an immediate impact, and people are going to have to think carefully about how they deal with it. The next thing is the sugar tax. It looks straightforward on paper, but the question is, how will the customs officer determine what has gone into a product? I imagine that NAFDAC will have to play a role here. Otherwise, customs officer shows up and says, well, this product, has met the requirements, it is carbonated, and you've added sugar. And I said, no, I didn't add sugar. It's just plain orange juice or whatever juice, which is sweet anyway. And so it's going to be, there'll be a few conversations along those lines on those kinds of products. Of course, the straightforward Coke and Fanta, there's no debate, but there'll be a number of products which, would be open to questions. And the customs will either have to set up their own lab or ask NAFDAC to step in and help them analyze whether this product has the things that they're looking for. Another thing is, although it wasn't mentioned by Ajibola, is export processing zones. There are two legislations covering taxation of those zones. There's the Nigerian Export Processing Zones Act, and there are provisions in CETA dealing with that. Now, CETA says that you must be exporting 100% of your products to enjoy the tax exemption, whereas the Export Processing Zones Act allows you to sell 25% into the Nigerian customs territory. It's not clear what should happen because there's a conflict between those two provisions. You know, I don't know, Jibola, whether your people, your committee looked at, at that at the time, but there's still the Next Act, which allows 25%, and you still get the exemption from tax. So that's something to be looked at. So taxpayers who are setting up in those zones will need to think about that and get some clarity as to how they will be treated. Another item that is not actually in the Finance Act, but it is something that taxpayers are increasingly having to deal with, is stamp duty on agreements. Now, for many years, the revenue did not pay attention to this. Now, when you enter into an agreement, the Stamp Duty Act says that there's a stamp duty to be paid. It could be 0.5%, 1%, 2% of the value or consideration that is, passing. And for a long time, the tax authorities did not look at that aspect of people's operations, and many people did not pay it. There was also the thinking that, there was no obligation. You only needed to do it if you needed to use the agreement in evidence in court, which is not quite correct. There is actually a positive obligation to pay duty, stamp duty. Now, the FIS has been looking at that when they do their audits. So it's one of the items they now look at. And a lot of companies and taxpayers are, getting a bit of a shock when they're told that, well, this supply agreement you entered into for 500 million, there's a stamp duty of 1 or 2%, and the numbers are not insignificant. The actual stamp duty rates are not small. They're Chibola is smiling, but that's the problem. The rates were there, and nobody was collecting it, so nobody bothered. So this is a time when the taxpaying community needs to engage with the authorities. Say, look, your rates are a bit high. We now agree to accept to pay, but what can we do about the rates? I mean, stamp duty on rents, for example, for some types of tenancies is about as much as 5-6%. People never realize that, but it's a big number. So people, the taxpayer committee will have to engage the Ministry of Finance and its people on how to manage these rates. We've gone past the issue of the levy on bank deposits, which for many years was controversial. There was almost no basis, but it was being collected. Now the law has created a basis and it's covered the arrears as well. I think I will perhaps leave at that point. Although one other point should be made is with regard to CGT, we don't have inflation indexing in Nigeria. So what you can have is a situation in which the value of the asset has gone up simply because of inflation. And so you're paying almost a tax on ownership. So if inflation is 20% and you bought an asset today for 100,000 naira, in a year's time, the market value of that asset is 120 because it's now more expensive to buy. You're paying CGT on that increase, even though it's questionable whether that is a real gain. In many countries, you have inflation indexing, and so the inflation element is deducted before you calculate the gain that is to be taxed. Perhaps this is too sophisticated an idea for now, but it's something that the more you start taxing people, the more they will have to say, look, am I really paying tax on what I should be paying tax on, or is this something, are you taxing just my ownership of this asset? Thank you very much.
Okay, thank you, Mr. Enua. Just to add to that issue as regards the CGT, when you pay 10% tax on 10% on the CGT for buying a company in terms of the shares, yes. You also have to pay some stamp duties as regards the transaction itself. everything now, the cost is now much, much higher than just the CGT, because you have to, the documents also have to be stamped.
Yeah. Sorry to cut in. I didn't say stamp duty. There's still an exemption for stamp duty on share transactions. What I meant was there's a FCCPC, which is the Federal Competition regulator. So when you're buying a company, you must get competition approval from that FCCPC, and they charge a fee, which is a proportion of the transaction value, and their fee is as much as 0.6%. Now you're asking an additional 10%. So anybody who's acquiring another company will have to think about those costs.
Thank you very much. Thank you very much. We have less than about 5. We're supposed to have closed that, but we'll do another 5 minutes for like question and answer. One of the participants actually wanted you guys to discuss about the Insurance Act, the amendment to the Insurance Act. I think probably so. I don't know if you can spend like about a few seconds on that.
Okay, Ajibola, will you take that?
Yeah, I'm happy to do that. I think the way to do it is to situate the difficulties that the insurance sector was facing. You had the Insurance Act that defined share capital for the purpose of measuring the capital adequacy of insurance companies by reference to paid up capital. What that means is that you can't use other elements of capital on the balance sheet. For example, if you have money in the share premium account, you have retained earnings, those were not being viewed as part of shareholders' capital. Meanwhile, the insurance regulator had mandated a recapitalization, which means that they need to go bring more money. So the only way to recapitalize would have been to ignore the other elements of shareholder funds in the company, go and increase your share capital and have it paid up before you can be deemed to have recapitalized. That was really, really onerous. So what Finance Act has done, in consultation with the Insurance Association of Nigeria and also with the insurance regulator NICOM, is to amend the Insurance Act and the provisions relating to share capital to make it clearer that elements of shareholder funds will now be included in the calculation of share capital. In a nutshell, that's all that was done to optimize the provisions and make it easier for insurance companies to meet the capital requirements of the regulator. That's a very important question, and I'm glad that it was asked. It allowed me to speak to an area I had glossed over in my own slides. Theo, in terms of your question, yes, we did have a lot of debate around the export processing zones and how it should be taxed, the conflict between CETA and the Export Processing Zones Act, and also the Oil and Gas Free Trade Zones Act, which was a third legislation. And to make matters a bit more complex, even though you've asked it as a lawyer, looking at the conflict of laws, there's also a presidential directive given in the days of President Obasanjo that allowed companies in the zone to actually export up to 100% of their output to the local market. In fact, if you look at free trade zones like Tinapa, there's no export activity in Tinapa. What you have in Tinapa are hotels, banks, and financial institutions. So really, what will be the benefit of being in a free trade zone like Tinapa to them if they got no tax benefit? So you also look at a company, there are some companies that are situated by virtue of government policy have been invited to situate in certain zones, and 100% of their output is intended for the domestic market. How do you deal with such? So a lot more thinking, a lot more consultation is required. You don't want to throw the baby away with the bathwater. And so I expect that in the next Finance Act, there will be provisions that seek to address this. I obviously am in support of a growing economy. And if promises have been made by the federal government of Nigeria, either by the president or by the National Assembly, and investors have brought capital into the country on the basis of those promises, we cannot then wake up when it's about maturity and then try and kill the goose that can lay the golden egg. At least let it lay a few eggs so we can take those eggs to the market. Why kill it at the point when it's about to start producing eggs? So we'll continue to have those conversations. I mean, I probably have showed my hands a bit early in terms of my own views, but my views are clear. We must be supportive of business. How will sugar be determined? Volume of sugar consumed. It's not by, that's why I said it's not about the input. It's about the output. It's not about how much sugar you consumed. It's in that you have a product that is sweetened product. So if you have a sweetened product, then you've got to pay tax, excise duty on that sweetened product. Stamp duties are high, you're right. But if you recall, one of the changes made by Finance Act 2020 was to make clear that there should be no VAT on rent or disposal of landed property. So in other words, you would have had to pay VAT on your rent. You then have to pay stamp duty on your rental agreement. The law has removed 57.5% and said, don't worry about VAT anymore. So yes, you may complain that the rate of stamp duty is high, but recall that the fiscal planners have already taken away 7.5% from your tax bill. So it's not all bad news. And also, there's a difference between the stamp duty rates in the legislation and the stamp duty rates in the FRS guideline. FRS is not the National Assembly. They're the tax. They can't change the rates. They can enforce what's in the law, but they can't introduce their own rates. So if you go back to the rates in the law are not onerous. They're actually quite low. So if you look at stamp duty when you are forming a new company, I think it's at 0.5% or something, or 0.125% or something as inconsequential as that. So stamp duty is not intended to be a significant revenue earner. In fact, many countries across the world have eliminated stamp duty altogether. South Africa has deleted it. And in the UK, where it still applies, it applies to only a very small category of instruments. And it's not as wide as what we have in Nigeria. Our own stamp duties legislation is a 1935 legislation. I mean, there's no time than the present to look at all these antiquated laws and bring them in from the cold. And I hope that you, as well as the chamber, I was glad to hear your comments that you have positions. I hope that you will be partners to the FPRC in reviewing all these things and making proposals to the Honorable Minister, who is charged with responsibility for the fiscal economy, so that the National Assembly can then do the needful to clean up all these things and make it easier for companies to do business in Nigeria. Thank you very much.
Thank you very much. I have two questions before we close.
Yeah, sorry, okay, can I just quickly ask Jibola a quick
please.
When I was talking about the sugar tax, what I meant was if you have orange juice, which is naturally sweet, right? I've not added any more sugar to it. It's just, that is how it came out from the fruit. And I carbonate it. Would that meet the,
the law doesn't talk about sugar at all. It's just us analysts that call it sugar tax. The law talks about sweetened.
But it is not sweetened, it is naturally sweet. Is that?
Until lawyers must eat. So, I mean, there's obviously going to be scope for consulting, for engaging, for arguing. But the law is clear. If it is sweetened, and just read it, says excise duty on non-alcoholic, carbonated, and sweetened beverages. So you've got to show that your product is not
doesn't mean that I added sugar to it or it came out sweet. That's the question.
Is it sweetened? It cannot be because when you say how will the customs official know? The customs official will just take a product, drink it, and tell you that.
Okay, thank you very much. Okay. Two last questions. Mr. Boa, you probably take this one.
Okay.
As regards education, and then Mr. Ajibola will take the final one. Educational institution now subject to CIT. In your opinion, will this in any way reduce the investment in education? And then the last one, Mr. Ajibola, deficit financing of the federal government by loan. How can we increase revenue without unnecessarily adding much pain to the taxpayers?
Well, with regard to education institutions, I think beginning to tax them, even for profits that are not distributed, is a significant change. The idea or thinking before now was that so long as they kept the profits in the business, or you might call it surplus as opposed to profits. I mean, the accountants may say this is a surplus, not a profit, But so long as it stayed in business and it wasn't given to any shareholders, then there was no tax to be paid. Now the law seems to be saying that. So if you have that surplus, there's a tax to be paid. But having said that, I think that in the real world, most educational institutions that are running properly do not actually make a profit. That is the truth. That is, if they are spending money providing high quality education, if you go abroad, many of the top institutions survive on donations and endowments from alumni. They actually cannot they don't have an operating profit because the cost of providing that education, exceeds, the revenues they may make from school fees, unless they charge school fees which are so outrageous that only a few would be able to afford it. So they bring the school fees down so that they can, attract students, but then they have to make up the difference from, endowments and scholarships.
Okay, thank you very much. Mr. Ajibola.
Thank you very much. So before I take the question on the deficit financing, I'd like to weigh in on the question of education. And there's been a lot of public dialogue over what the intention of the lawmakers are. But I think the way I was trained as a lawyer is to first look at the language of the law. So there's nothing in the Finance Act or in CETA that says that educational institutions should pay tax. There's no such direction. Tax is always on trade or investments, trade or business. What the law says in section 23, if you now delete educational activities, which is what all the law did was delete educational activities as a tax exempt item. So now it says the profits of any company engaged in ecclesiastical, which is whether you are Christian, Muslim, or animist, or charitable activities of a public character, insofar as such profits are not derived from a trade or business carried on by such company. It is possible for an educational activity to be done on a charitable basis, just as it is possible to do it on a for-profit basis. Yeah. It is possible to provide health services as a charity. It is also possible to provide health services for profit. So if your charitable business is education, then insofar as it is not for profit, this law says you're exempted from tax. So there is no law that says that educational activities will now be subject to tax in Nigeria. No such law. The Finance Act doesn't say so. CETA does not say so. What the law says is that if you are doing a charitable purpose, and like we know, for you to do it, you can't just stand up in Nigeria and say you are doing charity. You must write to the Attorney General of the Federation under KAMA. Your objects will be reviewed by the Attorney General, and he will certify that he agrees that you are doing a charitable object. Then CAC can register you either as an incorporated trustee or as a company limited by guarantee. So long as you are a charity, registered under the law as a charity, you don't have to worry about CETA. But if you are a private for-profit business that's also providing education, of course, you will pay tax on your profits. So that's just to explain the law. In terms of deficit financing, it's a very astute question. In fact, Theo did say in his commentary that Nigeria is spending a certain high percentage of its revenues to service debt. But people who make those comments are looking at revenue generated vis-a-vis outgoings. They're not comparing the budget to the outgoing. So if you take the total budget of Nigeria for last year, for example, the total budget was about 10 trillion, out of which internally generated revenue was about maybe 6 trillion. So you find that there was a deficit which was to be financed by borrowings. So if you take 2022 budget, the budget itself is also staged to be about, I can't recall now, I don't have the data in front of me, but it's about 13, 14, if not 15 trillion, 13 trillion, out of which internally generated revenue is expected to be, again, it's been increased from 6 trillion to about 8-point-something trillion. So you find that already in the plans for the year is the idea that internally generated revenue will increase. In those internally generated revenues, of course, you have things like the disagree between oil and non-oil. If you look at the component that is contributed by non-oil, especially given the low performance of oil in the last few years, you find that the contribution of non-oil has been growing at a very high rate. I also discussed with you a few minutes ago that the revenue generated by FRS, simply by adopting technology, in the last 1 year has been exponential, which means that we can expect more as that system stabilizes. So to answer your question, the fiscal planners believe that we need to widen the tax net in Nigeria. So it's not about making people who are already in the tax net pay more. In fact, if you recall, in 2019, okay, if you look at the data that's provided by the National Office of Statistics, up to 70% of employment in Nigeria is provided by medium-sized small businesses, MSMBs, medium, small businesses. They provide 70% of employment in Nigeria. The first thing the fiscal planners did in 2019 was to exempt companies that are in that category from payment of tax altogether. So if you were earning 25 million and below, you don't pay tax. If you are earning up to 100 million, you pay a lower tax, and above 100 million will pay the normal tax. That is to tell you that the idea is not to impose more tax on people. In fact, that category of businesses were also exempted from paying VAT. So in other words, the fiscal planners took burdens off a very active component of the fiscal economy that contributes 70% of employment and said, don't pay any tax. Just keep investing in your business. Keep growing your business. And then as your business grows, then you pay. So in other words, the idea is to widen the tax net. Now, when you widen the tax net, people come into the net. The second idea is to close tax gaps. So if your tax net is leaking, then people can start dropping out of it. A leakage, for example, could be NEPSA Act that Theo talked about. So you are saying that companies operating in a free trade zone shouldn't pay tax. That's a leakage. Now, but that's a strategic leakage. You are creating that leakage so that companies can come into NEPSA, come into a free trade zone, create industries that would ordinarily not be capable of being created in Nigeria. Take the Dangote refinery, for example. That's situated in a free trade zone. Imagine if we didn't have that. Now, the strategic planners of Nigeria are hoping that that refinery comes on stream so that all of a sudden, all our problems around petroleum importation will disappear, which consumes 60% of our foreign exchange spending. And that can disappear in one snap. That is an example of a policy that works. The NEPSA policy works. So some leakages are strategic. You put them there so that the economy can grow bigger. So you have wider, you also have plug holes. So what the fiscal planners have to think about is, when do I need to plug a hole? Should I plug, for example, we have the bond exemption order that applied for 10 years. Jonathan introduced that order in 2011, effective 2nd of January 2012, and it expired 2nd of January 2022. 10 years, nobody paid any tax on bonds and short-term instruments in the money markets. And then this year, the government allowed it to lapse, and so that tax hole closed. We introduced capital gains tax on shares in 1998. The military government introduced it in 1998. And it is only in 2022 that the fiscal planners decided to partly close that gap, not completely, just partly, for the high net worth participants, so that you can, because the net has now widened. Market capitalization in 1998 was about maybe 400. Today, it's about 30,000 base points. You can see that the market has grown. So you widened the tax net, and then you start closing the gap slowly. Now, those are the kind of dialogues that go on at the FPRC. Those are the things we need to bear in mind. When do we need to widen? What do we need to tighten? What do we need to close? What holes should we create? What more incentives should be given? How do we make this economy vibrant? How do we encourage companies to bring capital into Nigeria, invest in Nigeria, employ Nigerians, and grow a modern economy? I could go on and on.
Thank you very much. 60 years of experience on both sides. Wow. Okay. I must say thank you to, we're bringing this webinar to a close. So I want to say our special appreciation to the Nigerian-American Chamber of Commerce, the president and team members in the chamber. Our eloquent and articulate guest speaker, Mr. Ajibola, thank you very, very much. Our sincere panelist, Mr. Theophilus Olomola, thank you very much. AELEX for the financial sponsorship of this webinar, we say thank you, thank you. And above all, our over 100 participants, we say thank you. We hope this 1 hour has been very helpful to you in terms of making the business and financial decisions. Nigerian-American Chambers of Commerce on a monthly basis do have a breakfast meeting. And the next one comes up on the 4th of February, the theme Nigeria Economic Outlook for 2022, implication of real estate sector, and the guest speaker there will be Mr. Ayo Teriba. We'll request that please, if you can please join us on that Monday morning. I mean, I hope to all our participants, your goal has been achieved this morning with our two eloquent speakers having discussed in full implication of the 2022 Finance Act as it affects business once again. And then to the Mr. Mowa and Mr. Ajibola, the chamber actually has a plaque for you. So, but I don't see how we can present it virtually. So definitely it will be sent. it will be sent to the office. We actually appreciate your taking out time to be here. And once again, we thank you very much for this, for taking time out to enlighten us and give us more perspective as per the 2021 Finance Act. Once again, I say thank you and God bless each and every one of you and our participants. Thank you. And from what I have heard to the participant, the slide will be shared. If you can just please send your email address. Thank you very much once again, ladies and gentlemen, as we bring the webinar to a close. God bless you. And Mr. Adegoke, thank you also very much. God bless you.
Thank you very much.
Thank you.
Thank you. You're welcome.
God bless.